Hi all. Today we are going to discuss about fundamentals of accounting. Before going to the main topics, you should understand what is financial accounting. Financial accounting is a specialized branch of accounting that keeps track of a company's financial transaction. Using standardized guidelines, the transactions are recorded, summarized, and presented in a financial report or financial statement, such as income statement or a balance sheet. Meaning of accounting. Accounting is an information and measurement system that identifies, records, and communicates information that is relevant, reliable, and comparable about an organization's business activities. The goal of accounting process is to provide helpful information to users of financial accounting. Quality information may help the users reach more informed decisions. Accounting activities. Not all transactions entered into by a business entity are capable of being recorded. Our first task as accountant is to identify those transactions that may be recorded in the accounting system. To record business transactions, we must follow the rule of double entry bookkeeping system. Communicating business activities requires preparing accounting reports such as financial statements. It also requires analyzing and interpreting such reports. Accounting cycle. The accounting cycle is a systematic set of rules to ensure the accuracy and conformity of financial statements. Computerized accounting system and the uniform process of the accounting cycle have helped to reduce mathematical errors. Accounting cycle includes identifying and recording accounting events. The cycle is a set of rules and steps to ensure financial statements are prepared accurately and timely. The first step in the 8-step accounting cycle is to record transaction using journal entries, ending with the 8th step of closing the books after preparing financial statement. Accounting software today mostly automates the accounting cycle. Accounting cycle is generally a year encompassing an accounting period. Uses of accounting information. We must follow standard formatting when reporting information to users outside the organization. External users include stockholders of the company, lenders, various governmental agencies, and others. Internal users of the company includes managers, officers, internal auditors, sales staff, etc. Accountants also prepare reports for the internal users. Managers of the business need information to help direct and control operation of a business. The sales or marketing department needs information about customers and products. Officers of the company need information to develop strategic plans. Financial accounting provides external users with financial statements. Managerial accounting provides information needs for internal. Generally accepted accounting principles. Financial accounting is governed by a set of rules we call Generally Accepted Accounting Principle or GAAP for short. These principles identify three major characteristics of information. First, the information must be relevant. Relevant information impacts the decision of informed users for financial information. Second, the information must be reliable. Finally, the information must be comparable. Comparability helps us compare financial information from one period with that of the next period. Principles and assumptions of accounting. Here are some key principles and assumptions of accounting. Accounting principles. The measurement principle is also called as cost principle. It tells us that accounting information is based upon actual cost incurred. We refer to this cost as historical cost. The revenue recognition principle provides guidance on when a company must recognize revenue. The matching principle or expense recognition prescribes that a company must record its expense incurred to generate the revenues. The principle of full disclosure. It requires a company to report the details behind financial statements that would impact the user's decision. Going to accounting assumptions. Accounting assumptions. The going concern principle state that in the absence of information to the contrary, the business entity is assumed to continue operations into the foreseeable future. The monetary unit principle means we can express transaction in monetary terms. The time period assumption presumes that the life of a company can be divided into time periods such as months and years. The business entity means that a business is accounted for separately from its owners or other business entity, which means that a company and an owner are treated as two different persons. Accounting equation. The basic accounting equations state that assets are equal to liabilities plus equity of a company. The equation makes sense because in a general way it states that asset must be equal to the claims against those assets. If you have an asset, we can have two broad categories of claims against the asset. First, we have claims by creditors for liabilities. Finally, after all creditors' claims are satisfied, the residual owners and the stockholders have a claim on those assets. What are assets? Assets are the resources owned or controlled by a company. For example, cash, notes receivable, land, building, equipment, store supplies, vehicles, accounts receivables, etc. Asset may be viewed as a resource owned by or controlled by a company. Then, liabilities. Liabilities represent the claims of creditors on the entity asset. Liabilities include accounts payable, which means amount we owe to the creditors for assets purchased on account. Notes payable, taxes payable, and wages payable, amount we owe to our employees at the end of the accounting period. Shareholders Equity. The equities of an entity include investments by owners, contributed capital, and payment of those owners, example dividend. Retained earnings represent all the accumulated earnings of a corporation that have not been distributed to shareholders. Expanded accounting equation. Here is a breakdown of the equity section of the accounting equation to show the mathematical signs we will be using to keep track of investment by owners, common stock, payment to the owners, revenues and expenses. Notice that revenues increase equity and expenses reduce equity. Financial statement. There are four fundamental financial statements used in accounting. The income statement shows an revenue and expenses. The statement of owner's equity shows the change in owner's equity during the current period. The balance sheet is a list of all assets, liabilities, and equity account balances. The statement of cash flow shows where the company obtained its cash and how it spent its cash. Thank you. This completes our session of Chapter 1. We have introduced many new concepts and procedures. Hope you all understood every topic. See you in the next sections. Good luck.